The stock market is popping. The stock market literally cannot stop. If we go back to March 2020, the stock market fell approximately 30% when COVID-19 hit and there was true panic and uncertainty in markets. People were fearful. They wanted cash. They wanted liquidity. There was a liquidity crisis. So they sold their stocks. They sold their commodities. They sold their Bitcoin. They sold anything that they possibly could that was liquid in their portfolio. And they ran for dollars. The dollar strengthened, asset prices sold off. Since the bottoming of the stock market in the S&P in March of 2020, the S&P 500 is now up over 100%, has doubled in size. Incredible. During a global pandemic with very high rates of unemployment, we still have seen the stock market double off that bottom. And so when we start to look at it, the S&P 500, all-time highs. Dow Jones, all-time highs. Fed's balance sheet, all-time highs. Everything seems to just be growing up and to the right. Now, when you think about what drove so much of this stock market growth, we can go back to monetary and fiscal policy. The Federal Reserve decided that they could not sit by while there was short-term pain. There was too much uncertainty in the markets. They decided to come in. They started to provide financing and capital in the repo markets, bond purchases, etc. They also dropped interest rates with 2 emergency rate cuts to 0% interest rate environment. And then we saw from a fiscal policy standpoint, trillions and trillions and trillions of dollars was flooded into the system via various COVID relief funds. Everything from free money handed to airlines and other corporations, unemployment benefits absolutely popping, and also the stimulus checks that at the highest amount. Some people got over $3,000 over the last 12 to 15 months. And so while all this has occurred, the stock markets continue to explode upwards. In some way, the stock market now serves as an inflation hedge. Inflation at over 5% on a CPI basis. Where do you put your money? You can't put it in gold. Gold's down 10% or more over the last 12 months. But the stock market's been going the opposite direction. Here it is. The S&P 500 rally from the bottom in March 2020 now has hit 100%, absolutely doubling. But here is what is a crazy stat. This may be one of the craziest statistics we've ever shared with you on this show. Today is the 229th day of 2021. So there's been 228 days before today. Today's 229. Of those 229 days, there has been 157 trading days where the stock market is open Monday through Friday, hours of operations. So out of the 157 trading days in 2021, the S&P 500 has hit an all-time high or a record close 49 days of the 157. Almost 1 out of every 3 trading days in 2021, the S&P 500 hit an all-time high. Nuts. If you look at the Dow Jones has done it 35 times. So 1 in 5 days, give or take, the Dow Jones is at an all-time high. This is not normal. If you're just now getting into investing over the last 12 to 15 months, you have to understand that there is manipulation in the market. We are seeing a stock market that only can go up. Bear markets have been outlawed. Market corrections have been banned. And when you have interventionists in the market, this is what you get. Dave Portnoy said stocks only go up, and boy, was he right. It just continues to grow to the moon. If we look at how many days it took to actually get to a doubling of the S&P 500, coming out of the 09 to 2020 of February, took 540 days. Previously, these are the different timetables. The longest it's taken is from October of 74 to November of 1980. It took 1,480 days. Well, it only took 354 days. That's it. About 1 year to double. Absolutely insane. Now, most investors didn't necessarily buy the bottom of the recession during 2020. Of course, most people were actually selling. That's why the stock was going down or the market was going down. But for those that did buy it at the bottom there, they are now up 100%. Pretty incredible. When you start to think about why the stock market could be doing this, we've got a quote from David Kostin, who's the head of U.S. equity strategy at Goldman Sachs. And so outside of the manipulation of the market, outside of the quantitative easing, outside of the interest rate manipulation downward, he says, quote, "This quarter can be characterized by not only a large number of beats, meaning estimate beats, but also the impressive magnitude of surprises." So not only do people beat the estimations, but they beat them by very significant percentages. Companies' rising input costs can be offset or managed. Firms are taking advantage of excess cash and prioritizing investments for growth while simultaneously maintaining high levels of buyback. Essentially, what he is saying here is that Wall Street analysts estimated certain types of performance. The companies not only beat it, they beat it by very significant percentages. On top of that, companies who were previously worried and had indicated that their profitability or their revenue may take a hit because of inflation, higher input costs, etc. They've realized that they can simply raise their prices and they can pass higher labor or higher material costs on to the consumer. We have covered over and over and over again large corporations saying, we've been pleasantly surprised by the continued customer demand, although we raised our prices, and we plan to continue to rise our prices in the future. And so when you start to see this type of kind of manipulation or the passing of high cost onto the consumer, that's where you're seeing those very high levels of inflation, both core inflation and CPI. But David Kostin also said there that firms are taking advantage of excess cash. Now, somebody like a Michael Saylor would argue that there's literally tens of trillions of dollars sitting on these corporate balance sheets because they're fearful. They can no longer buy treasuries. They can no longer buy bonds like they used to. Their treasury management skills of the past no longer suffice because those bonds are actually delivering negative real rates of return. Remember, the nominal amount, the amount that is stated, may be positive, but when you incorporate a 5% or more inflation, the real rate of return is negative. So what are you better off doing? Holding cash, trying to find some sort of optionality. Well, if you have that cash and you don't have anything better to do with it, and you think your stock is undervalued, what do? You go and you buy it back. Buybacks are a form of a dividend. It's a more tax efficient dividend, but it's also manipulation of the stock price to push it higher and higher and higher up. There's usually all sorts of concerns or questions around the way that executive teams are compensated. And if their compensation is tied to the stock price, they may be more incentivized to actually buy back the stock rather than invest in R&D or something that could have long-term positive impact on the business. So when we start to look at the sector returns across this bull market, here's the percent change since the bottom of the market, March 23rd, 2020. You can look at something like materials, which is up over 120%. You can look at information technologies, up 120%. Financials, also up near 120%. Industrials, communication services, consumer discretionary, energy, all up over 100%. Even real estate and healthcare up 80%, and utilities and consumer staples up over 50%. These are crazy numbers. When you start to see things like the materials business, financials, energy, and also consumer discretionary, those are very, very different types of sectors, usually not overly intertwined, but they all are up triple digits. And so this leads us to the question, how much of the stock market appreciation is actually due to true growth? How much of it is due to better businesses, more profitable businesses, businesses that have a greater potential positive outlook in the future? Or is it simply just monetary manipulation? Is it simply something where the stock market will only continue to go up? And if you want to build wealth in this country, then all you need to do is simply buy low-cost indexes, sit back and chill. And Jerome Powell, Janet Yellen, and the rest of the monetary regime will simply make you rich. Hey guys, thanks so much for watching that clip of The Best Business Show. Make sure you like and subscribe to the channel, turn on notifications so you know when we go live every weekday, and then head to SoFi.com/pomp so that you can get an account and we can get after it.